Hello and welcome back to the Redhedge Podcast. Today we are here for a market update with Voon and Raphaël Reiner from the investment team. Hello both, how are you?
Yeah, I'm great, thanks.
Yeah, very good to be here again.
As always. So, what is the week that just passed? French election was the main catalyst to be discussed. Market has been taking this catalyst particularly negative. Of course, French risk has been selling off, especially into the financial sector. Banks, especially subordinated debt of banks, have been quite weak recently, but across corporate as well, we've seen a bit of weakness. EDF came with a new issue just the day after, what was it? The Tuesday. So the catalyst of the new election into the weekend, and then the Tuesday they came with after a very weak session on Monday on French risk, they decided to come out with a new deal, which was surprisingly, in terms of, for me at least, in terms of timing, but good enough for us because they decided to leave some basis point premium on the table, which we weren't used to see in the last couple of years. And new issue premium was close to zero, actually negative through the curve most of the times, which didn't leave much on the for anyone on the table in any given issuer on IG. So we have had that. The deal traded well off the break, and then CPI number helped the market a bit. What is the real risk on French election? How worried should market be, in your opinion, on this catalyst?
I think until we were still and sort of the timeline is quite short in terms of when the election happens, but still a lot of things can change between now and then. I think once the dissolution of parliament and calling new elections was a big surprise to everyone, and so it'll take a while for polling numbers to be a little bit more accurate and for everyone to get a sense of what they expect to happen. The way that the election is structured in the two rounds, similar to how the French presidential election is, means that there's a lot of dynamics at play, and it's very difficult to get a real sense of which fraction or which party is going to have a majority at the end of both rounds.
But the question is, if Macron doesn't win, what is the factual change for the country stability and in general for risk assets? Who is the worst case scenario? What is the best case scenario in this output? Whatever output is, what is the binary case?
Well, the presidential elections is not until 2027, and Macron has recently ruled out stepping down as president if his party loses. However, we as a market, as a risk manager, we cannot rule that out. If they suffer a big loss, obviously we could see, basically a limp president, and this might force his hand or gives him no other choice to quit. And this, I suppose, is the bare negative case scenario where we see instability in France. And also, we've seen in Europe in general, everyone leaning towards the right, and France has been one of the main propagator of a closer, much stronger union within Europe, like a closer Europe. So if Macron, for some reason, has to step down as president a lot earlier, then we could see this European project come under pressure, especially with geopolitics being the main risk here. If in the US, for example, in the US elections, if Trump gets elected, we could also see a foreign policy shift in the US, where the US may start to shift away from supporting Ukraine in the war, or even in a tail scenario pulling out of NATO. And this would cause a huge amount of instability in Europe. I think that is a bear case scenario. It wouldn't be in the short term, but it is something that we would have to see play out in the next 1 to 2 years.
Yeah, I would also add to that, so obviously there's geopolitical changes that might happen. The other thing that I would be concerned or am concerned about is the inexperience of these far-right parties in actual governance. Le Pen has been in opposition for the past, 30, 40 years, sort of her father and her. They have zero experience actually running a country. if you suddenly put them in a position where they have to have a proactive role instead of just opposing everything, it can lead to bad decisions. I have no idea what kind of mistakes, but there's a level of uncertainty that you have to price in.
Okay.
Some people are comparing it a little bit to the inexperience of Truss when she was sort of prime minister in the UK, and we saw the implications of that and how quickly it unraveled.
Definitely, there is geopolitical uncertainty. Election here in the US is always uncertainty by definition, and I guess investors will take cautious in putting risk to work and be more conservative overall, just based on the fact that there is an election upcoming, and overall European stability is a threat always, I feel, and especially when the higher for longer, even one and done type of cuts that we've seen from ECB, which led again to a bit of weakness, which I think was a very unmeaningful weakness, almost a healthy repricing of a very tight situation. And rates instability is, I think, making some people nervous. We've seen outflows into long end IG credit, which in fairness is probably the most appealing point of the curve, given where rates were when those outflows happen, in a way that in absolute yields, looking at the absolute yield is the most appealing, one of the most appealing points on the long end, 10-year plus, just based on the fact that, of course, you have a lot of vol on rates, and rates vol is not coming down as much as probably some of the new alpha donors, we call them tourist investors, I'm sorry, I defined, but people that bought credit now, never bought credit in the last 10 years. They're getting nervous on long end. It could be a matter of times that they get nervous on the 10-year point, and then eventually they really just hide into very front end. Perhaps I think rates volatility is keeping the attention of the market right now. Credit is almost resilient to anything, if you wish. Is like if there is a geopolitical catalyst, like French risk will be wider. Otherwise, it's business as usual. Is all the eyes on rates. What can change? That is my question.
A lot of investors have been piling into credit this year, exactly like you said, because the yields have started to look attractive. But what has happened instead is that the credit spreads have compressed a lot due to this. And if you're buying credit at the moment, you're really just buying rates, because the credit component is very small. But I still understand, because at the end of the day, they're looking at some of these names which have 5, 6, 7% yield in Europe, but issued by strong issuers. And if you look in the past 10 years, there has never been the case where you could buy, IG 8 or BBB plus rated issuers at 5-6%, and now you could. Most of these guys or investors are long only, and they care about the absolute yield levels. So the danger is that because of these kind of inflows and technicals, even though these credit bonds are trading at a very high yield, they actually are on a very, very tight spread. So most investors are not getting compensated at all for owning this credit. So I think that the risk reward here is pretty poor, and that is one major downside risks that I see.
What level of spread, which is $1 trillion question in the market? The idea is, to me, because sometimes when I speak with people, they always say, if it's tight, when is it wide enough, in your opinion? And I have an educated answer. It's like ECB, QE, it was a big catalyst to drag everything tighter, and the pandemic program did it even more. So my reference point for credit spread is pre-QE, and the idea is credit vol has been mitigated massively from the stability of a passive unconditional buyer, which will flatten vol on credit systematically. Now we haven't seen weakness and so real volatility in credit. Reinvestment has been announced in the latest ECB meeting will be stopping at the end of the year. So literally 2025 we have no ECB direct buying anything, practically speaking. So we will really see the BTP Voon spread level to be tested because of course, especially with the pandemic program, we know that they didn't have restriction in maturity, so BTP curve was sustained by very long end purchase from the central bank. We will know hopefully, or it will be organic, a bit of volatility. So how far the weakness will be pushed at some point when put into challenge. And so in my opinion, the level of credit spread, which is healthy for the market and is not drugged somehow, and is pre-QE levels of credit spreads, give or take a percentage of that.
I think that credit spreads follow, if everyone's making money and they're not having to take any losses or any significant volatility on their credit components, then they will keep piling in on what they consider sort of a free bonus. Instead of buying rates, they buy highly well-rated IG companies and feel like they're getting a premium for free. I think we need to see the economy deteriorate. I think we need to see some name-specific volatility in high-quality names again for us to get a normalized credit spread. What that is, I think, looking at it at pre-QE levels makes a lot of sense. I do also think that we can't ignore the fact that where rates are, people are simply looking at it as an all-in yield, and that the credit spread itself is just a little bit less relevant for a large portion of the investors.
Of course, we need to adapt to the market. As much as anything else, the market is always right, and until it isn't, because of course we need to be aware of the surprise, be prepared for a surprise, but access the fact that is the levels where we have been in for a while is the new normal, and it will take something to go in a different cycle. Could be cutting. The idea for me, what my best case more than a negative catalyst is if when we start to have a series of cuts and inflation actually comes down, I think I could argue that the credit spread will be wider because people that have bought credit at certain rates level will take profit. We bought now at 5-6%, 2% will not be that appealing, and so they would take profit. And in technically healthier environment, we will have profit taker, which the yields will be similar, but the credit spread component would be more relevant in the absolute yield. So I almost think that when everything will feel better, we could have a normalization of credit spread. That is most likely scenario to me. Most likely that will take a while. I don't think we are yet in a position to see a series of cuts happening as we priced the end of last year. We were right in our previous podcast discussion. The market was a bit ahead of itself, but definitely it's something that will come at some point.
No, absolutely. It's almost like buy the rumor, sell the fact kind of trade. The market has, we've seen in the last couple of years, always been trying to front run what they expect would happen, right? So in a way, like we are seeing even now, or a few weeks ago, a bit of a summer flow, and everyone is piling into carry trades into the summer because they expect low volatility and just a general grind in the market. Similarly, the ECB cut was fairly priced in, and obviously we had the ECB who cut a week or so ago. But if we get further cuts, the market would, like you said, would be happy to take profit, and there would be no buyers on the other side, mainly because a lot of the yield buyers would be sellers, and the spread buyers are not really buying because spreads were already very tight. So it is very likely we could see some normalization at that point. And also we would expect as well in the risk premium may increase a little towards the second half of this year, mainly from mostly election risk, I would say. The UK is going to elections. France, obviously, is one, the big one. The US, a lot of the modern, the Western world is going into elections. So the volatility is there.
The most bearish traders and portfolio managers spoke with last month, in the month of May, they were all telling me the summer started earlier this year. It's going to be summer from May rather than from July. And obviously, I strongly disagree with that. But, you cannot fight the market. Everyone was just positioning themselves on carry positions and reducing the gross exposure for competitors and dealers was the key. And pile up carry was the key. And the feeling I've had this week of trading with the French election was that the risk, people are full of risk somehow, which cannot really take anymore, just because this early feeling and vibe of summer has made books full of what is a position is typically resilient in a market where nothing really happens, not talking about being very long duration exposed or having a lot of risk on, but be full with the carry component of the risk, which I always, anyone that knows me knows how reluctant I am to be short vol somehow with this type of trades. But the idea is market has risk on, so feels like, especially fast money and market makers, as a position in which feels summer type of position. That's why catalysts like that can shake the market a bit more than we will expect in months where everyone was a bit light. I will expect a bit of opportunistic buyers into the French risk when AT1s were down 3 points in a session. You expect a bit of it felt like a bit of a straight line up to when everything stabilized overall, like with the CPI number, which has bring a bit of strength to the market itself, stabilize rates and so on. So that is a feedback to be considered. And again, second half of the year, September especially, can lead to a bit of two-way surprises somehow. Of course, if we keep having good inflation numbers, CPI projections will be tighter and tighter and a bit more is on that sense. I expect strength into the market, which is fair and expected. But once that is priced in, is all a risk. We are just exposed to whatever is going to be the next negative headline, especially when risk is in the books.
Yeah, I think we can't. The inflation component is one part, and that's stabilized, and that's overall it's positive for the market that we don't need to price in further hikes now. In my mind, the key is to see how quickly the economy deteriorates, or what the impact of sort of higher for longer. They did raise rates quite substantially in the US and in Europe. That will have an impact on the general economy. You're seeing it in financing. Real estate was the one that was the first. Any large purchases, reinvestment in businesses, it's been lagging. We know that the economies have sort of generally termed out their debt more, both on the sort of consumer and individual side as well as on the business side. But at some point, businesses and individuals are going to see their sort of monthly coupons increase to a level where it starts to really impact their investment and their consumption. And so, do we see the consumer really start to weaken? And at the same time, we're seeing more and more pressure from governments also increasing tariffs again. We're seeing more tension as, this kind of goes back to the election year. In an election year, you have to posture a little bit. We're seeing the EU just announced sort of substantial tariffs on Chinese cars. Considering how big the auto sector is in Europe, I think that's something that you can't sort of just leave aside.
Definitely, that is a sector that I don't like personally, in a way that cyclicality of the auto sector and where its trading is tight in a way that compared to other sectors is not offering, as compressed as anything else. Now we adding up the variable of the tariffs, and I don't like it even more in a way that especially issuers which are exposed to Asia, which with Trump, we the trade war has been a dynamic which we personally have particularly been exposed in a positive way, because of course our arbitrage type of strategy is benefiting from vol, so I was beneficial for us, but not for the market, and particularly punitive in auto sector and cyclicality overall.
I also think this tariffs is here to stay, regardless of if Trump or Biden wins. As we saw with the Biden administration, he hasn't actually reduced or gotten rid of any of the tariffs from the Trump era. So, in fact, he's probably. I think we don't know. These tariffs are going to stay, and China, on the other hand, will have no choice but to have also retaliatory measures. Right? They have to retaliate to these tariffs and placing tariffs on their own. So we're seeing a world that is, globalization coming to a halt and coming a little bit on the reverse. So we have Europe putting tariffs on China. China will probably retaliate. The US doing the same for Europe, NAFTA, China, everyone turning towards a more protectionist type of policy. So obviously this is not great for growth, and this should put a little bit of a dampener on global growth, in the medium to longer term.
What about the UK? UK, which is the place where we live, which we love, which is challenging us somehow in different fronts. What is the biggest risk? There is the most, the election is obviously in the pipeline, and we know that either way there will be some fiscal impacts for some more relaxed fiscal rules that UK was famous for, which will probably have an effect of, in cities like London, could be suffering on the back of that. Labour could kill the middle class on the VAT on schools. What is the view on this country in terms of risk?
I guess it comes down to competitiveness, right? The UK before this has always been viewed as a very competitive place to do business, to immigrate into, to move to, because they're competitive on standard of living, etc. But if the new governments coming in, putting, getting rid of res non-dom, it makes it a little bit less attractive for a very small subset of people. But changing the status on schools and charging VAT on schools, it puts the cost of living in the UK, just a little bit higher, which reduces attractiveness by a little bit, right? And it just makes the UK a little bit less competitive to other places to live in, like in Europe, post Brexit. And notwithstanding, I wouldn't say that the Conservatives have done a good job over the last 10 years, but who knows with this new, if we do get a Labour government, which the polls seems to suggest at the moment, well, this is an untested government with a lot of new names, with untested figures. So we do not know how. Echoing what you said, that these people have not been in government for a long time, and we do not know if they are capable of running a government in somewhat difficult situation here with low growth and high inflation. It is a very difficult position to be in. How do they generate growth and instill back optimism in this country? It is a tough job, and I don't know how anyone would go about to achieve that.
Yeah, I definitely think it seems like a foregone conclusion that Labour is going to be in government again. One thing that I find noteworthy is that it's going to be the first time since Brexit that you have a sort of much more pro-European party in power again. And so I wouldn't be surprised if they implement some measures to, bring the UK closer again to Europe, when the Conservative government of the past few years has been pretty, clear in trying to position themselves as a further right and more measures to kind of separate the UK from the EU. And, I don't know what the impact of that will be, and if they will make it easier again for some level of migration from EU states to the UK. But I think it's something to keep an eye on.
Absolutely. I think, as always, there is, market is too tight and not pricing a lot of risks. It feels like a broken record, but it is what it is. It is what we are witnessing right now, which we cannot hold back in expressing. As I always think, is the best methodologies to avoid concentrated risk in general. Concentration and be cautious in this period is key always in any business type of investment and so on. So I guess we will see the next update next month, what has happened into the summer, and then we will see back after that in September with our summer post. Well, thank you both for participating once again.
Thank you.